Welcome to this White Coat Investor Real Estate Webinar. I'm here with Anthony Morena of the Mortar Group, and we're going to be talking about what they do as well as real estate syndications and what you can learn about those and how you ought to think about them and how you can evaluate them and so on and so forth. Welcome to the webinar, Anthony.
Good morning. Thank you for having me.
Let's introduce them to you a little bit to start with. Why don't you tell us a little bit about your career, kind of how you ended up in real estate?
Sure. My background started about 25 years ago in the architecture field. Went to architecture school, started there, and then shifted over the first 5-6 years of my career into development, started working for architects that were developers, and essentially found that model more interesting than the traditional architecture model. And essentially went on this path or this personal kind of process to create an architecture and development firm. And now being 25 years in, we do our own projects. We don't have any clients on the architectural side. We basically design and develop our own projects with a syndicated group of investors that we work with and that we've relationships that we've built over the last 20 years. We do predominantly multifamily residential in New York and in the outer boroughs of New York. We do a mix of ground up construction. I would say 5 to 30, 40 unit buildings in the 10 to $30 million range on project sizes, and we'll do more traditional value add projects in New York. So we do a little bit of both. The percentages of ground up to value add kind of changes from year to year as the markets kind of move and fluctuate. That's the quick version.
Sure. Well, tell why New York? How come you chose New York? Is that where you were? Is that where you're from? Is that where you love? Or did you see it as a particularly attractive place to invest in real estate?
It's a good question. It comes up a bit. So I grew up here. I grew up in New York. And my first project in 2001 was with my dad as a local project that took way longer than it should have, more so because I didn't know what I was doing. And you learn and you start to, from there, we started doing projects in different neighborhoods in, Brooklyn, Queens, Manhattan, which we were familiar with. And as we expanded and as we started to do more projects, we realized that our specialty was in part architecture and local knowledge. New York City in general has a pretty particular set of zoning codes and building regulations. And being familiar with them and being able to analyze and look at sites pretty quickly just from having the architectural or the technical background was a benefit. So we felt that was one way we can create value where some other companies couldn't. And then with that, we just developed a local knowledge where we had the teams in place, whether it was from the sales, brokerage, construction, where we knew all the parties that we needed to complete a development or acquire an asset. So it just became this thing of local knowledge where we knew what we were doing in different spots. Like if we picked a neighborhood, we can tell you pretty much everything about it, what the comps are, the history of the market. So it was a local knowledge that, we kind of developed. We explored looking at other cities, over the last 4 or 5 years, especially during COVID, when everyone was kind of running from New York as quickly as possible and kind of shifting more down south. And we looked at some of those deals and they were attractive, but the concern was that I was looking at deals in Miami that I was familiar with Miami to a certain extent, but I'm going to Google Earth and I'm looking at a site and the neighborhood, and I'm relying on other people for comps and stuff like that, where my strength was local. So I was like, okay, instead of, in some respect, almost guessing on and taking a leap of faith on certain types of cities outside of New York, I was like, let's stick where we are, where we know. Our staff, our team is kind of scattered throughout New York, so everyone kind of has their own neighborhood specialty. And, we're kind of growing our business slowly. So the goal is, okay, be strategic and build out the business in New York in kind of our own backyard.
What do you see as the advantages of New York?
It has its pros and its cons. It's a market that when things are going well, the national market, is a little bit different than New York, but at the same time, they kind of mirror each other. New York is stable, as far as, as long as you're avoiding the outskirts or areas that are not really gentrified yet. I think it's a pretty stable market. There's well-established comps, and you've got population growth that is, slow and steady through the years. It has its ups and downs, but overall, it's a growing city. You have technical or tech hubs that have kind of been appearing, in different parts of the city. It's evolving. There's certain areas, certain neighborhoods that get upzoned over time, and those areas kind of explode. And there's always kind of little things happening in the city. It has its political, and regulatory issues that you have to kind of navigate. But that's just the price of doing business here. It's been great. It's been a lot of fun to do it here. It's nice to see projects that we've completed 20 years ago and how the neighborhoods have kind of evolved around them, and then our new projects, how they evolve into existing neighborhoods.
So tell me a little bit about the challenges. You mentioned regulatory challenges. You mentioned political challenges. Let's talk about some of those and that people ought to be aware of before investing in New York.
It's always involved. It's always evolving. New York. Regulations are always kind of changing. You have to stay on top of the market, what's going on, what's being rezoned, what's being downzoned, how rent control is affecting certain projects. I think if you're familiar with it and you understand it, it's a lot easier to navigate. So for us, we can look at something pretty clearly and understand the path to do so. I think that's where part of the architecture and the technical background really comes in handy, where we can look at a deal where 10 other developers might have passed on it, but we might have an understanding of something that maybe they didn't because they hadn't given it to their architectural consultant yet or the zoning specialist, and we can look at that and kind of take it from there. Every market has its challenges. In New York, especially during COVID, had a big decline, and then it came roaring back. The growth in New York was almost 18 to 24 months behind the rest of the nation in a way. So it was a bit of an anomaly in that way, but it's usually a pretty stable market.
Let's talk about a typical project that you guys do. Take us from beginning to when it's complete. What's the round trip look like?
Sure. So we have a couple projects that we started, I would say, in the last 6 to 12 months that are ground up construction. And the idea is that we'll always kind of, we have a pretty close connection with a lot of brokers and people that are selling deals off market or on market. And, we'll look at different sites, we'll analyze them architecturally pretty quickly, and see just, back of the napkin what works and what we can do on a particular site that can make it a little bit more unique than the traditional development. Is it a design aspect? Is it a zoning feature? What can we do to create value where someone else can't? So we would look at something and then go through the typical process of underwriting, getting our comps, making sure our numbers make sense, and talking with lenders, kind of seeing where they are. We have a bunch of contractors that we work with, so we'll kind of talk to them. It's like, hey, where are you guys seeing marketing and or market prices, and where do you see things going? And we'll have them bid out the job, and then we'll take it up the track from there. We'll do a lot of the underwriting, or I would say a lot of underwriting, a lot of design before we close on an asset. Traditionally, what happens is when a sponsor or a developer closes on acquisition, then they'll start spending the money to design and get approvals in place. What we'll do is, because we're in-house, once we have a project under contract, we'll spend the money internally to get the project approved during the contract phase. So if the project doesn't close, it's a cost that we eat. But we won't start the process until we feel pretty confident that we're going to be able to close. But we'll get all of that stuff done during, let's say, a 4 to 5 or 6 month contract term, so that the day we close on acquisition and the bank interest meter starts spinning, we're ready to break ground within 2 weeks. We'll have our contractor lined up. We'll have the drawings approved. All of our budget line items will be pretty much locked. so that when investors come in and then we go out to our group of investors to syndicate and see who's interested, a lot of our costs are kind of fixed. We know where the market is from a comps perspective and where sales are. So we lock everything in place and then we're off to the races. And the plus side of that, what it does is it shaves about 6 to 12 months off a project term. So instead of being a 4-year development, we try to do it traditionally, we'll try to do it in about 30 months. That's kind of where our average is for a lot of deals. And I think, with the ground up construction, you get a nice IRR, you get a nice return on your investment, but it's in a shorter period of time. So you get to, investors get to put their capital back to work. And it gets us a chance to kind of move on to new projects and kind of slowly expand the business.
So from the, you mentioned where the investors come in. Let's talk about how this looks from an investor perspective. And what they should expect from their experience as part of the project.
Sure. So, we work with, I think we're about 324 investors that we work with now. We started off friends and family, and they kind of slowly expanded as word grew and as we started to do more work. Now we have a group of investors where, as a deal comes up, we'll post something on our website on the investor portal. We'll put together an offering, budget information, all the details, and we'll send it out to everyone and just see who's interested. And then we'll raise the commitments. We'll sign a contract on the acquisition of the asset, and then we'll usually call for capital about 2 to 3 weeks before we close. And then we're kind of off to the races. We'll keep investors up to date, with your traditional kind of quarterly reports through the investor portal, K1s that we try to get done by February 15th. That's always kind of our target. I know that's something that I've learned over the years that investors are really want to make sure they get from us. They don't want to be delayed on filing their stuff. And then we'll do annual reporting on the financials of the project, the budget, see how we're doing. And it's been a growing process that we've been going through as we're growing. How to be more transparent? What can we do for more information to keep people in the loop? Just with the project, what we're doing. So we've used the investor portal, on-site visits. People will come by the office. We always welcome everyone if they're New York based or if they're in town, come by, grab a coffee, grab lunch, or come take a look at the site. So it's been a lot of that, just trying to make sure we're effectively communicating. That was one of the big things that I kind of learned and the team learned of coming out of COVID was make sure that everyone's kind of knows what's going on, and everyone reads things in the news of things going high, things going low. So you want to always kind of keep everyone in the loop to make sure, everyone knows where we are.
Now, these projects, particularly the ground up ones, I assume there's no income coming from these while they're being developed.
Sure.
And your entire return comes at the end of the project. Is that the way most of your projects are structured?
So the ground up construction ones, we'll set them up where it's a 30-month term where investments come in, we close on the acquisition, we build. And then after the completion of the project, there's the sale, lease up, or lease up and sale. And then after that, we'll traditionally have the lender who's paid back. Then investors will have their pref that's paid out to them. And then usually it's about a 70-30 split in favor of investors. And it's usually about a 30-month term. So there's no income during the project, but it all comes at the completion via the waterfall. The value add deals that we do are more of your traditional, where it's quarterly revenue, whether it's 5-6% as the asset grows. The term on those projects are a little bit longer. I would say usually 3 to 5 years as you improve the asset. But with construction, it all comes at the end.
Yeah. So let's talk a little bit about the track record. How many total syndications has Mortar gone round trip with?
So we're approaching about 30 projects that we have done or we have under construction. We've gone full circle, I would say, on a couple dozen at this point, a little bit more than that. So yeah, it's, at this point, early on, it was always kind of trying to show investors how we've done, but now it's gotten a little easier as we've gone through and we have an extensive track record.
How many projects do you have? How many projects do you have currently in process?
We'll do about, I would say, 5 projects that we have running concurrently. It ranges from 4 to 6. We have a bunch that kind of finished up, and now we're starting off a new round of work.
And what's the average IRR been on the on the ones that have gone full circle?
So it varies. The deals have kind of varied from, I would say, about 16 to about 20, 21% on the IRR.
Have you ever had one that lost money?
Hey, yeah, I have. I think when you're in this business long enough, it happens. We've had one project that went negative. It was a condo ground up construction project during COVID, where yeah.
Let's talk about that one and what you learned from it.
Well, it was the perfect storm. It was one of those things where we went all hands on deck to try to save the project and make sure that we can get out of it and protect investor capital as well as we could. There was a loss. I think it could have been worse, but it was the perfect storm when we had a project that was ready to go to market in February of 2020. Market shut down a month after. The New York market just tanked essentially, and you were down about 15, 16, 17% on sale prices. It was a condo development. It wasn't a rental or a more traditional kind of value add. Then you had running interest rates that, kept on going for an extra 18 months that you hadn't really planned for. You had a contractor that went bankrupt. You had, just a slew of issues. And unfortunately, we tried hard to save that one, but it was the one project that I would say that went negative. And, we learned you can't plan for code in the future, but, you try to look at everything and you try to give yourself enough runway and enough margin to protect capital, protect the asset as you go. On the value add side, we've never lost investor capital. All of those projects have done extremely well. But yeah, that one project during COVID is our first loss, which was tough after 20 years to get your first one.
Now, tell me your process of when you brought the investors in on the challenges that you were facing there.
It's just a matter of communicating and keeping everyone up to date. We kept everyone up to date quarterly. It was a lot of conversations. So we deal with our syndicates, are investors that typically invest $25,000 to $500,000, $25,000 to $500,000. Depends on the investor, depends on the group. It's mostly individuals. We don't deal with institutional capital or very many family offices, so it's people. So in that particular project, it was conversations. It was literally, just talking with everyone one-on-one, explaining what the situation was, any questions that they had, and then also providing them with the data as it was coming into us. Where's our budget? What are comps looking like? What's our timing? And you try your best to navigate that situation and communicate it effectively why things are the way they are. And when things are going well, we try to do the same thing. We try to keep everyone in the loop, and you go from there.
Now, you talk about your investors. Who's your ideal investor, and who should not invest with you?
It varies. Our ideal investor, it's like I was saying, it's people. I like the personal relationships with syndicated investments where, of the 300 plus people we work with, I know most of them. I've spoken with most of them. And it's just having that kind of personal relationship. It's like, for me, it's like I stick with residential development and value add. I like multifamily work. I'm not big on commercial or office, not because it's not lucrative. It's just, I like this kind of segment of the market. I think my architecture background helps sometimes and it hurts, but I like the personal interaction of residential development, and the same with syndicated groups of investors. So with dealing with people, I like that kind of perspective of it. I like that even dealing with people we've met through White Coat, it's an interesting group where we all have kind of the same goal to, we all, are trying to save and protect capital, grow our investment towards retirement or whatever our goal is, or whatever tax strategy someone might have. So it's always interesting to kind of find out what's someone's objective and how is it a fit for them. With the investors, as far as who shouldn't or who should, it really depends, like I was saying, on their objective. What's the goal? We do offerings that are shorter in term. We're, ground up construction projects are 2 to 2.5 years. Our value add is 3 to 5 years. We're not doing 10-year funds. We've looked at it. It's something we've explored a little bit, but as of right now, we do these shorter term. So, we've had a good response from investors that like project specific offerings where they can look at a deal and they can see where it is on the map. If they're local, they can check it out. So it's that kind of group that we like, and I think that likes the kind of work that we do.
Now let's talk about that for a minute. There are some investors that like funds, some investors that like syndications. Tell me what you think the advantages of investing in syndications are over turning your money over to a manager that's running a fund of syndications.
Yeah, I think it depends. Like each investor has their own risk profile. For us, I feel that project specific is a little bit less risky. Or if you're doing, we'll do some offerings where we're taking a few different assets and pulling them into one syndication. It's not a fund, but you're spreading your risk throughout a few different investments. And it gives investors the chance to see, what they're working on or where their money is. And I think, we've gotten a good response from that. We've done some stuff on the fund side in the past. But we felt we got a better response or more interest from investors that knew exactly, especially with the ground up work. With ground up construction, people want to see where is this going on, what are the comps, what's the market like, especially in New York. I think once you start to leave New York, you have a little more flexibility. But in New York, it's so neighborhood specific that people like to see what's going on in that particular area.
Now, you're obviously a principal of the company. How dependent is it on you? I mean, what's the risk if you get hit by a bus tomorrow?
15 years ago, if I got hit by the bus, it would be a problem. It was one of those things that as we expanded, this was kind of a question that came up a lot. It was like the key man issue. What happens? So we set up systems, and when we started off, in 2000, 2001, through 2008, I was the guy. And, we had a few people that we worked with. Our staff was 3 people. And as we've grown, we've set up, we still have a small office. We're still kind of tight knit and efficient. We're 10 people, but we have a development team, architecture design team. We do construction administration through the development, but we'll hire out contractors for construction as well as for sales and brokerage on the marketing side. And we have a property management group. So we try and investor relations. So we try to be efficient that way. And I try to step back and focus on the overall mission and the goal of the company. And I would say every quarter to 2 quarters, we'll talk about everything. And even in that respect, as far as the key man concerns are, just to make sure that we have everything in place, because it's come up. And when you're dealing with 10 investors, it's one thing, but as you get into the hundreds, and as we grow as a company, it's something that we wanted to address. So it was one of those things that became a priority for us.
Okay. Well, what happens when, not something happens to you, but something happens in the investor's life and they're seeking liquidity? Is there any way to get capital out before these deals go round trip?
There is, we've done it where, usually we have the option, usually. So when we close on an asset, on a ground up construction project, the investor capital and our capital is spent first before the bank will do any funding in the project. So it's illiquid during the course of the term by the documents and by the PPM. However, real life being what it is, if something arises, and because we're dealing with individuals and people, we try to navigate if that situation is there to make it work for someone and cash them out if needed. It's dependent on the situation basis on where the projects are or the investment is at that time.
No guaranteed liquidity, but it is a possibility, it sounds like.
Yeah.
Okay. A lot of investors worry about private real estate investing in general and prefer to stick with, the public markets, public REITs, et cetera. What are your thoughts on the advantages of why an investor ought to consider, private syndications with you versus just investing in the Vanguard REIT index fund?
Sure. No, it's a good question, and it comes up a lot. It's one of those things where it's, we are one of the options that are out there. I think you you know putting money in indexes is an important way to do things, but I think there's other alternatives that you can have to spread your risk and also look for a little boost on the return that will help average out your portfolio a little bit higher. I think it's a blend. I think putting all your eggs in one basket is not the best thing. I think spreading risk through different investments is a good thing. And a lot of our investors, especially those who invest with retirement assets or like with self-directed IRAs and stuff like that, they've got their investments spread across the financial markets, and they've chosen real estate and they've chosen New York as one of the items where they feel comfortable investing in. So they'll move money into those kind of investments. But I think it's just important to be versatile with investments across the board.
Let's talk about some specifics. Let's talk about an example of one of these deals. Why don't we talk about the one that you're currently raising money for as we record this? Mm-hmm. And obviously, anybody listening to this in the future, this investment may no longer be available. But let's talk about it, because I think getting into specifics is helpful for people to really understand a deal. Sure. Do you want to tell us about that? I know you have some slides. Should we put those up and kind of walk through a deal?
Okay, so this is an offering that we are working on now. This is a ground-up project that we're doing in Astoria, Queens. It's in an area called Haylet's Cove. It's about a half a block from the water in a growing part of Queens and the Astoria neighborhood. It's a 32,000 square foot development, 29 units. This was a project that we signed a contract to buy during, I guess, 21. It was kind of like the last of the COVID discounted type developments. It was an asset that we bought. We bought air rights from the adjacent neighbor. And the idea here is it's a ground-up construction project, 9 stories. So our goal with the Vision offering is the project is under construction. It started. We just finished foundations on it, and it'll be done probably by the end of 23. And we'll be going to market for sales and lease-ups at that point. This project has 2 classes on the investment side. One is your traditional Class A investor that has an IRR of about 21. And then the preferred equity investment side, which is an annual return of about 15% annually. That's paid out quarterly over the course of the project. This is just a mock-up that we had done early on, just to give investors a sense of the project itself. And then traditionally what we do with any project, whether it's a value add or your traditional ground-up construction project, we'll run the pro forma 2 ways. First, it's as a lease-up, building it, stabilizing it, and then the sale of the asset. But then we also look at it as a condo backup. Because the markets always kind of fluctuate between rental and condo, you want to be able to know on any development that we do that you can do well and hit your IRR returns both on the condo side and on the rental. As the markets fluctuate, you want to be prepared for both. So the way we did that was, we just broke out this pro forma for investors to kind of see how it's broken out in both ways. And then we'll show a development budget that shows the sources and uses of funds over the course of the project, from the purchase to debt service, hard costs, and the soft costs. And like I was saying earlier on, we have a lot of our project costs that are locked when we sign or we go to close on the acquisition of the asset, like we did here. The biggest variable that we've had to navigate with this project is interest. So you just make sure that you are budgeting properly for your interest reserve to complete the project and complete it well. And you always have a contingency. We'll have 10% contingency on the construction side and about a 5% contingency on the project overall side. And then this is a breakdown of the rental development and sale with the sources and uses and how the operations, we flow through operations into reversion on the asset. This shows the investor return on the Vision side, which is preferred equity side, which shows a 15% annual return. And then you also have the breakdown on the Class A investor side, which has a breakdown and shows a return of about 63%. This
So
is
how
a
should an
great.
investor choose? The investor comes up and learns about this project, and they're trying to decide whether they want to invest, as an equity investor, Class A investor, or whether they want to take the preferred equity option and get a little bit, not a guarantee, but a little bit more of a guarantee. How
Sure.
should investors think about that? Which side should they invest on, depending on their goals?
So it really depends. The vision offering and this project in Astoria is kind of the first uh, of its kind where we offered both sides. The Class A offering was closed, and then we had an opportunity to provide a preferred equity position on the project after the fact. I have found that depending on the timing in the market, where investors, some investors want to go for the bigger IRR. They want to get that 20% IRR return on a project. And then others want to like the stability of knowing what that interest is going to be. So they can calculate it annually. I expect X amount every year from Mortar, and I expect a check for X every quarter for the life of the project. It's different investors. Some people have done both. But I found it interesting where you can provide it with smaller projects. You can provide some flexibility to investors and give them options. And I think we've done it piece by piece over time, but I think it's something we're probably going to expand, especially in this market where interest rates are spinning out of control, where and the rates are going up. I think investors are looking for some stability with the preferred equity, where they know that they have a 15% interest return that's coming in from the project. The preferred equity gets paid second in line after the debt. And then you also have the investors that have a growing rental market during the course of the last year and ongoing in New York, that they're going to benefit from the sellout on that side. So they'll have a gain that'll meet their IRR expectations as a common equity member. So I think the flexibility has helped, and it gives people options.
For those who are just joining us, I'm talking with Anthony Morena of the Mortar Group. You can get more information about that at whitecoatinvestor.com/mortar. Anthony runs the Mortar Group. He's a principal there that is a syndicator, an operator in primarily New York City properties. And so we've been talking about how he does that and why he does that and what opportunities are available to investors there. Now, you mentioned an exit strategy that I'm aware of because I've talked to you about it before, but I think this is a little bit unusual, and I think a lot of people may not know exactly what you're talking about. When you talk about your condo exit from a project, tell us what you mean by that.
Sure. So your traditional investment or asset is either your traditional value add, where you're renting up, leasing the asset, improving it, and then stabilizing and then selling the asset, and then paying investors their returns as promised. The other option is with ground up construction. It's the same thing, where you complete a project, you lease it, and then you sell the asset. What we do on the condo backup is some projects, we try to model them both ways, where if the objective is to rent out a building at completion or after renovations are complete and then sell, but the market is not in your favor at that time, we look at a condo exit, where instead of renting the units, we will sell them as condominiums in the same time frame. So for Astoria, the project is a 36-month term project. So at the completion of the project, or usually halfway through, you'll make a decision: do we need to shift our path from rental to condo, or vice versa? And at that point, you still meet the objectives of the timeline, but instead of selling the asset, the one unit, you're selling each unit individually. You pay off the lender, and then you pay back investor equity, then their preferred return, and then their share of the profits. But the idea behind that is it's a second level of security that in case the rental market declines, like we've seen great growth and we expect the rental market to continue to grow in New York, but invested in the event that it does decline, you have a condominium backup where you can sell those units and protect the return for investors. I think it gives us some flexibility to make sure we try to, meet our marks on the investment side, and it gives investors a little bit of flexibility and looking at different risk, managing their risk where you have another exit in the worst case.
So of those 24 projects that you've gone round trip on, how many of those have you taken a condo exit?
A lot of them, the ones that we've done condo were meant to be condo developments. We've never had a project that's really shifted midstream. I think early on, we had tried to look at some, but we always stuck to our guns where, we were able to make the numbers work. And it worked out well. So we've never had to switch one midstream just from market fluctuations.
Tell me about your risk management process.
Well, it's an important piece that we're continually monitoring. When a lot of times, sometimes you would start a project, you do all your comps and your underwriting early on, then you start construction, you kind of leave things to be, and you build or you do your renovations. With us, we're always trying to monitor. I think it's on a quarterly basis where we're really looking at things. Where's the market going? Where is it headed? And you try to, you make adjustments as you go, whether it's value engineering or making a modification on design. In 2008, or, when the Lehman crashed, we had a project that we were a few months away from launching for sale, and the market went upside down. Citibank, I think the stock crashed to $1 at that point. It was the worst time to do anything. So we made adjustments. We made adjustments to the design. We value engineered, made some modifications to the units where we can try to pull more revenue out of those at the time, protect capital, adjust the term of the investment to get investors out and protect their capital and deliver an investment, a return.
Now, if an investor, this new model you have with the preferred equity option, if an investor chose that, do they get the depreciation passed through to them as well? Or do you have to be a Class A investor to get that on your K1?
It would be a Class A investor that gets the depreciation. The preferred would not.
Does the preferred equity investor get a K1 or do they just get a 1099?
They get a K1.
And I presume they would have to file in New York as well?
Yeah, so our accounting team would put together their federal return and a New York State K1. We internally handle the New York City taxes as part of the closeout of the investment, but they would get New York State and federal.
Okay. And tell me about your debt. How do you source your debt?
A lot of it is through relationships that we've had over the years. After going through a couple of dozen projects, we've got a pretty good Rolodex of lenders that we work with, whether it's on the rental side or it's or traditional value add or more construction side. We've got different lenders that like different things. So, they're comfortable with us and it works well. Like even, when markets tighten up and certain lenders might close their books to new debt or new construction loans, they'll consider us or they'll look at our deals just because of the relationship that we had where they know that we've paid them back. We've completed, we've gone full cycle. We've paid them back. They've been happy with the way we did things. So, we'll always try out new lenders, different brokers, different sales teams. But we have a pretty good network that we work with, even with contractors. We try to keep everything within our group. So just we manage expectations for ourselves and for investors, just so we know what we're getting into.
And do you typically take out fixed debt, or is it typically a variable debt, or what do you usually use?
The value add is usually fixed. We'll usually do like a 5-year fixed term. Construction is floating just by the nature of the product. Some of the value add stuff that we finished, or we just acquired in the last 6 to 8 months. 6 months ago or 8 months ago, we locked it. It was like 3 3/4, and we're like, we wish you could do it better. But no, looking back at it now, it's worth its weight in gold.
What challenges have you faced from rising interest rates over the last year or so?
Planning. It's making sure on the construction side that you have an interest reserve to meet the demand of the project. When you're doing your underwriting, you have to make sure that you have enough of an interest reserve planned on the project. And then also on the value add stuff, when you're navigating your exits or you're plotting your exits, you have to make your adjustments on your cap rates. And if you don't make those adjustments, that's where someone could get into trouble. You always plan for the worst case. You like to look at the upside, but you've got to be realistic and look at where things can go. And you plan for the worst. You shoot for the upside and you shoot for the best, but you've got to find that sweet spot.
And you mentioned quarterly communication. Any other communications that investors should expect when they invest with you?
It's like I was saying, it's a process that we're working on to get better as we go. We do our quarterly reports, our financials. We're working on now trying to do video shots of projects, do walkthroughs as things are under construction or under development, or if we're renovating an apartment. We'll give updated projections on numbers for operations. We're working on doing some more webinars or mid-quarter updates for investors if a piece of news comes up for the project. Instead of waiting 2 months to give them that update at the end of the year or the next quarter, we'll try to give updates that way. And we also keep our portals available 24/7 with all the information up there. But then we make ourselves available to any questions or calls. Like I always let everyone know that I'm available for a phone call or a meeting or email. We have our investment team that is always kind of addressing any questions or concerns investors have. The idea is just to be transparent and available. I think that's the key to it. But it's one of those things we're always trying to get better as we go.
And what do you do to make sure your underwriting, your pro forma, is reasonably conservative?
You have other people look at it. I tend to be a little conservative when I look at things, and the biggest thing I've learned, you have to be realistic when you run your numbers. You always have that slide or that pro forma number. Like a pro forma can look any way you want it to. You can be completely unrealistic and promise the moon, and you won't get there. So you try to be realistic. So I look at something, I'll be conservative. Then usually we'll have the team look at it and say, okay, what do you guys think? Is this realistic? Are there any line items that we think we can be off on? And what do we have to monitor or adjust to navigate that? And then we have relationships with marketing teams, brokerage teams that we'll send it to them and they'll take a look at it for us and think, okay, what do you think? What do you think of these numbers? What does this make sense? It's hard sometimes to project, 30 months out, but I think we've gotten to a good point where we'll plot the different variables, upside, conservative estimates, and kind of see where you go. And our projects in general will build in enough margin where, in the event of a market shift or a downturn, you try to be able to absorb any fluctuations in the market, on any deal. I think the nice thing about some of the projects that we work on is, and like I was saying, with lenders, you have a pool of people that you work with and relationship you have. And it's the same thing on the marketing side. We've worked with certain brokerages on the sales side of selling an asset, renting it, or even when we're buying an asset. And, you see people in good markets and bad, and you can select and work with the teams that can do well in both sides. Like, a lot of people can do really well when a market is doing really well and it's flying high. But when the market goes down, how do those people respond, or how do we respond? I think that's how we set, the team in place with, that's a long-winded way of saying just, we try to be selective about the groups that we work with, and we try to be realistic. So we make sure we work with people that will give us real data.
Do you typically estimate a higher cap rate at the exit than when you purchase? And if so, how much higher?
It really depends. So for now, we're in New York, cap rates have kind of started to move up, but it's always slow going. But you're projecting, I think, 3/4 of a point higher on our exit at this point. you have to, you want to, I think everyone has their guesses of where the interest rate market is going to go and the cap rate market is going to go over the next 12 to 24 months, but you have to be realistic and plan for, the worst.
All right. Well, our time is getting short, but I wanted to give you a chance to offer anything else that we haven't talked about with Mortar, anything else people ought to know about it and your investments.
I don't know. I think we've kind of ran through everything. We're a growing company. The goal is to be transparent and efficient with investors and work on our communications and get better with that. There's a lot of companies that do value add ground up construction across the country. We try to provide ourselves or present ourselves as an option. We're a smaller company, but I think there's a benefit to that. There's a relationship that is formed with investors that we've gotten to work with over the years that I think with larger firms, people that level is not established. And there's familiarity there that I think people have come to appreciate. And we've seen great growth with our investor group coming through COVID and coming out. So I think we're doing it the right way, and our goal is to finish this next round of work. Every project that we do, with any of these deals, it's a slow growing business. You complete a project, it takes 30 months before someone puts an investment with you to try you out, see how you guys do. And it takes 36 months to go full scope. It's not like someone buying a stock or buying Bitcoin and then a month later the manager can look like a genius. It takes us 30 months to kind of really go through the process and establish that trust. So it's something we take to heart, something we want to make sure we do the right thing with that person. So they feel comfortable with us, they trust us. And a lot of times it's those kind of relationships that really grow more than anything else. It's that investor that put their toe in the water, found that they liked working with us, and then it kind of expanded from there. They brought in colleagues or friends that they thought, would be a good fit. And that's the nature of our business, just expanding it that way. Real estate is a big asset class, but it's a small world. So you try to do the right thing and go by that.
Do you find most of your investors come in with $25,000 or $50,000 to try you out, and then bring a lot larger sum when they come to their second deal with you?
Yeah, sometimes I think sometimes people want to try you out and just like I was saying, just see how you do. Do they like the stuff that you're doing? And typically it expands. If we give someone a good IRR, a good return on their investment, usually, whether they come in with the same amount or they increase, they'll usually invite someone else or someone else or a friend or a colleague, and it's this slow expansion. So you try to make sure you do well by everyone, where you can slowly grow this group and grow the projects that we do. We don't really change much in the assets that we do. Like I was saying earlier, we stick to what we know. We try to be efficient at what we know, but we try to do a little bit more of it as we grow as a company.
Awesome. Well, we've been talking with Anthony Morena with the Mortar Group. If you'd like to get more information about the Mortar Group, this is a vertically integrated real estate syndicator that does projects in New York, many from the ground up, but also value add projects. If you'd like to learn more, you can at whitecoatinvestor.com/mortar. Thank you for your attention today. Hope you enjoyed the webinar and learned some more both about Mortar and about syndications in general.
Thanks, guys.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.